Okay, and then the last list were at discounts to intrinsic value. So these were the ones that we thought were cheap.
Yeah.
They were A1 businesses, great quality businesses, and they were cheap. None of them declined, except for one, which is we've already mentioned, DWS. Matrix Composite and Engineering is up 50%, and that was my star. You remember
the
one
CEO
stock.
of that company should sent you a very big bottle of champagne for Christmas.
Well, thankfully they don't give gifts that the company manufactures, because I don't know what I'd do with the buoyancy module. So Matrix Composite and Engineering was the star pick for 2011, up 50%. Nick Scali up 2%, JB Hi-Fi up 2%, Oriton up 12%, ARB up 10%, Centrebet up 12%, DWS down 9%. Or 9.6, and for an average gain of 11.3%, which is almost double the market's return of 5.7%.
Yeah. So, in a sense, a lot of those companies would qualify as being small cap, you think?
In this case, yes, but if
and small caps have done well.
If people who have been following this, and many of them go to my blog and watch this, watch these stocks, and I talk about them throughout the year. If you go back to sort of the start of 2010, you'll see there were more large cap companies that were good value. We talked about the banks, and we talked about a whole bunch of businesses and whether they were good value or not. But as the year has progressed, fewer and fewer large cap companies were cheap, and what remained were the smaller businesses. Many of these fly under the radar, and that's where a lot of opportunities are. A lot of fund managers can't buy these because they're not in the top 200.
How do those companies rate now for you? Have you been able to, are they still the companies you think have potential? If this market should go up another 10% over the year, do you think those companies still...
Well, Matrix remains my, a star pick. It's also at a discount to its intrinsic value. People will look at the price chart of Matrix, and I've been talking about it now for more than a year. And I think in that time it's doubled, or no, it's more than, sorry, it's tripled.
So your fans that love you and your cynics say he'll get it wrong one of these days.
Well, and you will get it wrong. The reality is that's what diversification's all about. You're not going to get everyone right.
Of course not. And if you're perfect, I wouldn't have you on this program. It's your imperfection that I like, Simon.
Right.
Roger. Right. So the two Simons.
Like your imperfections too.
Two Simons in the program. Okay. As long as you didn't say Dave.
No.
Now, the important point is Reject Shop. You've always loved that business, and it really hasn't done well for you.
No, that's not true. If you remember, we talked about it.
But our visit, yours. But talk us through what happened with Reject Shop.
But we talked about it last year, and I said, like JB Hi-Fi, I think it's maturing as a business, and that remains the case. And in fact, I wrote a piece which you put on your website about the Reject Shop, and saying that, look, I think it's maturing now, and I think it... And in reality, I probably was a little bit premature. I said that when it was about $15 or $16. It went all the way up to 19. So it looked like a right royal git for doing that. But now it's lower.
In this game, you're always open to that.
Well, now it's lower than it was when I said that. And I do think that what's happened is that the return on equity profile of that business is maturing. It's flattening out, and it may not decline, but the only way to keep it up is to increase the dividend payout ratio so that the company has less capital retained, then it can got a smaller equity base, and it can keep its return on equity high. Otherwise, its return on equity will decline.
But it also had two incidents, didn't it? It had the flooding was one, and when I was in America, I read there was another incident. Well, they actually came out and said that the earnings was not going to be as good as they expected. So it was
there was a downgrade. Downgrade, if you like.
Okay.
And JB Hi-Fi, the same thing has happened with JB Hi-Fi. Look, in Australia...
But it's done okay, despite that.
Peter, we've got 22 million people. We don't have the sustainable competitive advantages in this country that US companies can muster, because they've got 14 times our population. A good retail concept will quickly roll out, it'll mature, and then what does it do with the extra cash that it's generating? It either has to buy back shares, it has to give the money back, or it goes out and makes a stupid acquisition. And the third option there has been a well-trodden path in Australia, and it's resulted in value destruction. So eventually the return on equity flattens out, the increase in intrinsic value starts to decline. And I remember at the start of last year, the increase, or the percentage increase, or percentage growth in intrinsic value was going to be very, very steep, and now it's less steep. In fact, I've got my 2013 valuation. It's declined by about 30%. Sorry, about 10%. No, 30%. Out to 2013. So if it was $30, it's now closer to $20 out to 2013. And that's a reflection of the maturity of the business, which I was saying was going to happen.
Okay, so next time we meet, can we revisit not necessarily the companies are on there, but if they have to be brought in, do that.
Sure.
What are the companies at the beginning of this year where the intrinsic value is greater than the market price?
Sure.
Okay?
So they're starting to get thin on the ground, but there's still a few.
Yeah, and the thing is the people who doubted you unfairly, now we're saying, well, he did well, let's give him a go. Well, I think
one of the things investors do when they invest in funds, there was a study done many years ago in the US. They found the average gain on a mutual fund over a 10-year period was about 11%, but the average gain of the investors in the mutual funds was about 2%, and that was because they always switched and went with last year's best performer.
Exactly right. Oh.
Big mistake.
Okay, so going for you this year could be a bad mistake.
It might be, you never know.
It's very bad publicity, but very, very objective.
If I keep doing this for 5 years or 10 years or 15 years, it's worked historically. There's no reason it's going to change.
Okay. Well, that's why you're on the program, mate. If we thought you were a loser, you wouldn't be here.
Thanks, Peter.
Thanks, Roger.